Now we're going to start getting into the technicals, the basic foundation. Okay, we're going to start getting into the technicals. All right. Unknown. You either make yourself accountable or you will be made accountable by your circumstances. Guys, it doesn't sound like much, but when you get into the trading business, you're going to see, okay, you're going to see that if you follow your plan and follow the rules, good things happen. When you don't, bad things happen. Stress, frustration, okay? It's literally the difference between being able to afford a tent and being able to afford a nice house is the difference between breaking your rules and following your plan. Okay, you will see. Between breaking even as a trader and making $5 or $10 or $20,000 a month is simply the difference between following your plan. Okay? Trends, up, down, and sideways, candlesticks, volume, moving average. These are the most important things that we use to make money. Okay? We're also going to talk about the market stages. All right? So, as I said earlier, we like to keep things simple. Okay? Like to keep things very simple. So I don't want 92 different indicators in my charts. Now, you guys will notice out there, nowadays, there's an indicator for everything. There's Fibonacci retracements, there's Bollinger Bands, there's relative RSI, relative strength indicator, there's put-call ratios, you name it. Okay, stochastics. There's like 300-400 indicators out there. They're junk. Okay. Let me preface by saying I don't mind if you have 1 or 2 indicators on a chart. I don't really use them and I don't think they're necessary, but I don't mind it. Anything more than that is bullshit. Okay? I'm not kidding with you. Anything more than that is BS. Volume and price are the only 2 things you really need. We use moving averages to help the newer traders discern trends better. Right? That little line helps them discern the trend better. I don't use it on my charts. I use price and volume, price and volume. Why? Because that's all you really need. The price is the price of the stock. Higher, lower, sideways. The volume is the level of commitment. We're going to talk about that in a moment. Okay? So, the only thing you really need to make an informed decision on a technically based chart are candlesticks, which are price, volume, and moving averages. I also look at level 2 to help get better entries, but that's not an indicator. That's actual price. Level 2 is actual price. It's the price inside the candlestick. Okay? So we're going to talk about those 3 main components, candlesticks, volume, and moving averages. And we're also going to talk about them within the 4 market stages. So we have 3 trends, uptrend, downtrend, sideways trend, but they also happen within 4 market stages. Okay? So, simple, uptrend, multiple higher pivot highs and higher pivot lows. Multiple. Okay? You'll see in a second. Multiple lower pivot highs and lower pivot lows. Okay? Lower highs, lower lows. You'll see LH and LL. Okay? Or LPL, LPH, all right? Okay? Equal pivot highs and equal pivot lows are sideways trend. Smooth uptrends and downtrends, guys, they're far easier to make money from than sideways trends. Sideways trends, as it says, are by definition non-directional. They are sideways, okay? So it's simpler to make money from clearly trending stocks that are in uptrends and downtrends. So I would recommend you stick with those. It's not necessary. It just makes your life a little bit easier, okay? This is what you want, okay? Stock hanging out. Remember I said sideways trends can be challenging? Pulls back, moves up, pulls back, moves up. Notice the moving average here. The blue line is the moving average, 21 period exponential moving average. Notice there's only 3 things on the chart. Candlesticks, which are volume, moving average, and did I say candlesticks? Candlesticks, which are price, my apologies. Candlesticks, which are price, moving average, and then volume. Stock's going sideways, a little bit hard to discern. It's really struggling to get over $26, but it's also holding the $21 mark, okay? So struggling to get over 26, struggling to break below $21, $20, whatever. It's in a range bound. Well, it's a lot harder to make money in a range at sometimes, okay? So when the stock finally breaks above the range, it becomes a lot easier to trade. bounces up, pulls back, bounces up, consolidates, bounces up, pulls back, bounces up, pulls back, bounces up, pulls back. It's going to continue this. You ready? Higher pivot high, HPH. Higher pivot high, higher pivot low. Right? This pivot high is higher than this pivot. This pivot low is higher than this pivot. So a higher pivot high, a higher pivot low. Another higher pivot high, and another higher pivot low. Another higher pivot high, potentially another higher pivot. Notice the moving average is riding this up. Okay, every time it comes back to the moving average, notice the moving average is riding this up. Okay, every time it comes back to the moving average, it bounces. Pulls back to the moving average, it bounces. Okay, this is a power trend. Stock went from $25 up to $44. Okay, it's another type of a core trade. That's a nice, a beautiful, smooth uptrend. Now, a downtrend, another smooth downtrend. Now, I want you to take note here. The last chart that I show you, okay, yes, 21 period exponential. You can use a 21 or a 20 period moving average that, simple moving average, doesn't have to be exponential. I'm very, very, very flexible with moving averages simply because I don't really use them. So if you want to use a 20 period or a 21, that's up to you, okay? Also, keep in mind, when you drill down to lower time frames, like a 1 minute chart, you're going to want to use an 8 or a 9 period moving average. Okay, exactly, Derek. 9, 21, and 200. Again, you can use SMA, which is a simple moving average. I don't care. Just stay consistent with it. That's all. I don't care. But 9 period on a lower time frame, 20 on all time frames, and a 200 on the higher time frames. Okay, we'll get into that in a couple minutes. Downtrend. One of the things I want you to notice, though, the last chart I showed you was an uptrend, but it was on a higher time frame, like a daily chart. Now we're showing you a downtrend on an intraday 5-minute chart. Excuse me. So you can see that these patterns and these trends are relevant in all time frames. I don't care if it's a yearly chart or a 1 minute chart. A trend is a trend. Uptrend, downtrend, side. It's a trend. So this stock was in a sideways trend, holding the $28 mark, but it couldn't break $28.50. Just stuck in a range. The next day, that's the day break there. The next day, breaks below, drops, consolidates, drops, consolidates, drops, bounces, drops, bounces. Notice, it's riding the moving average the whole way down. So that's a lower pivot low, LPL, lower pivot low, lower pivot highs, right? So if you look at this pivot compared to this pivot, and this pivot and this pivot, they're all lower, 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 lower. Multiple, 2 or more makes it a trend, right? 2 or more lower pivot highs and lower pivot lows makes it a trend. Then at the bottom, you begin to transition. So at this point, it's really extended. Guys, it went from $28.50 to $24.50 in 3 hours. That's a huge move. It's 20% move. Volume comes in at the bottom. Notice 1, 2, 3, 4, 5, 6, 7 red bars down on top of the huge prior move. 7 red bars down after a huge move, plus a bottoming tail, plus volume. Bounce. And then what does it do for the first time? For the very first time, right here, it puts in a higher pivot low. Notice that? These are lower pivot lows. This pivot is lower than this pivot. This pivot is lower than this pivot. This pivot is lower than this pivot. These are all lower pivot lows. This is the first higher pivot. That's an HPH, higher pivot high, or higher pivot low, my bad. HPL, higher pivot low. Now we're putting in a higher pivot high, higher pivot low, higher pivot high, higher pivot low, higher pivot high. Now we've changed direction. We've transitioned. Downtrend, sideways trend, short term, uptrend. Okay? And here is the sideways trend. These are much harder to make money from, guys. Now, if it's a tight, smooth, controlled sideways trend, not bad. Okay? Not bad. But these are tough to make money from. I would rather trade an uptrend or a downtrend because that's easy money. Right? Higher pivot high, higher pivot low, that trend will likely continue unless massive volume comes in, okay, or you get some wide range ending bar, which we'll talk about later, okay. Sideways trend, it can't break the 15.25 mark, and it's having a hard time breaking the $12 mark. I don't really want to trade this in here. Now, some people like to trade these. They go, oh, well, it's in a range. I can just trade it within that $2 range. And you can. Equal pivot high, equal pivot lows, okay? But it's harder. I personally would rather wait for this wide range bar to take out the resistance, right? This is where resistance means sellers, guys. That's why it's in red. Support means buyers. This line is support, okay? I really move that up to here, right? Okay, that line is support. This line at the top, sellers, resistance. So notice at the end here, the wide range bar takes out the red line, and then you get a resting day, and this next day, oh my goodness, what a great swing trade is this going to make? Right around the $16 mark, stop is less than $1. Oh my goodness. Guys, this thing was stuck in a range for months and months and months and months. It's like, I don't know, a tiger being stuck in a cage and you finally let it out. It's going to explode. Wide bar takes out all the resistance. Narrow bar is a resting day, and this day, boom. That's when I'll trade it, when it breaks the range, not inside the range. I'll repeat, I'm not going to trade this inside the range. I'll trade it when it breaks the range, higher or lower. Okay? All right. This next section is very important, guys. Okay? It's very, very important. There are 4 stages in the market. Understanding what stage the stock that you're trading is in is paramount to success. Okay, as it says, imperative to success. All right. The reason it's imperative to success is because we don't trade stocks, we trade emotions. And you need to know what other people are feeling in order to profit from it. Okay? It's the truth. You need to know what other people are feeling to profit from it. All right? So stage 1 is a sideways stage, okay? We consider this an accumulation stage, okay? As it says, it's associated with fairly uneventful emotion, apathy, indifference. Guys, what's indifference? Indifference is, I could take it or leave it. Where do you want to go to dinner for tonight? I don't really care. I'm not that hungry. Don't care. Whatever's fine. You don't care. And a stock trades like it doesn't care. Low volume, narrow range, limited activity, okay? General lack of interest. I don't care. All right? Oftentimes a stage 1 will happen after a nasty stage 4. Don't get me wrong, it can happen after a regular stage 4, but it'll usually happen after a nasty stage 4. People are sick of the stock. They have no interest in it anymore. Screw it. I don't want to talk about stocks, right? Uneventful, limited activity. Stage 2, this is the stage that the average person makes money in, right? The average investor does not short stocks. The average investor. Okay, you guys are far from average, but the average investor does not short stocks. Okay? This is what we call the demand stage. Okay, the demand period. This is where buyers are excited, happy, euphoric. All right? Wide range move with increased volume, lots of activity. Okay, this is a stage where most people make money because this is the only way average people know how to make money. You guys are going to be able to make money in all 4 of these stages, but preferably stage 2s and 4s. Okay. Stage 3 is that sideways stage like stage 1, but yet very, very different. Okay. Here it's accumulation. Here it's distribution. There's a difference. People are accumulating the stock at cheap prices, the people that know, but on a limited activity basis, right? This is totally different. This is a back and forth tug of war between buyers and sellers, okay? It is typically sloppy, but not always, which means it's wider range. There's a lot more activity in a stage 3 sideways trend than there is in a stage 1 sideways trend. This is half the people think it's going higher, half the people think it's going lower, and they're battling it out, UFC style. Stage 1, nobody cares, man. Nobody cares. Your 15 minutes of fame is over. We don't want to see you anymore. Here, you're fighting to stay relevant. So you have half the people going, no, it's going higher, I know it. And half the people go, no, it's going lower, I know it. So anxiety, uncertainty, all right? There's a fight going on here. Stage 4 is a supply, okay? Nobody wants the stock anymore. Supply outweighs or overtakes demand. Too much of something that nobody wants, okay? Lots of selling, fearful traders and investors who want to exit the stock. It's usually the fastest moving. Why? Fear is more powerful than greed in the stock market. Okay, you guys saw the chart, the Great Depression, right? You saw the chart in 2008. The market goes down typically a lot faster than it goes up. Okay, because when people want out, the crowd theory, the sheep theory, they all pile in. And we'll talk about that in a minute as well. So this is what it looks like charting wise. Stage 1, just hanging out sideways. Okay, moves up, pulls back, moves up, chops a little bit, moves up, pulls back, moves up. The difference between the stage 3, and I'll show you on a chart, okay? We should have put a chart in there on this. Surprised I didn't. All right, the difference here, okay, is that this is much more wider range. This is much more narrow range typically. But in the stage 2, guys, you're going to have pullback buy setups, and you're going to have breakouts as well, okay? Something I want you to think about. This is how this works emotionally. Nobody cares about the stock. Nobody cares, okay? The people that are buying down here are, quote, professionals, okay? When I teach professional trading strategies, I use this analogy. I use a fashion analogy, okay? Not that you guys are into fashion, but it works. So let's just say that, I don't know, we'll talk about bell bottoms or skinny jeans or whatever. It doesn't matter, okay? The designers are coming out with a new design, and at the moment, in stage 1, they're the only people who know about it, okay? So they're creating this now. They're hoping to create demand later, right? They know right now there's no demand for this product because they haven't finished it and marketed it yet. So what happens is they create the product. That's stage 1, the creation of the product, okay? Again, let's call it skinny jeans, okay? So they think they have something on their hands here, this great new product called skinny jeans. So the first thing they do after completing this product is start working on marketing campaigns and then releasing this product in limited quantities to celebrities. Oh my gosh, I want Jennifer Aniston in these jeans. She's going to look great. I want Scarlett Johansson. She's going to look great. So what happens? Celebrities get in down here. So what's the relationship to the stock market? This is where the pros are getting in. This is where your Goldman Sachs are getting in. Your Merrill Lynch, they all have the inside track on everything. Okay? Mom and pop are not getting in here. So the celebrities get it first. Limited quantities, and then all of a sudden what happens? Now you're seeing marketing campaigns on television. Now you're seeing the celebrities go down, I don't know, the red carpet somewhere wearing those jeans. All the young girls out there go, oh my gosh, I gotta have those jeans. Did you see how thin she looked in those jeans? OMG, right? This is Goldman giving a taste to their top clients. Goldman, not yet releasing to the public, giving a taste to their big hedge funds and clients, okay? That's the red carpet. That's the celebrity status. Okay. Then as we get to the next level up, now you're starting to get into the smaller but yet inquisitive, intelligent investors. All right. This is when it's starting to go mainstream, right? Starting to go mainstream. Now everybody knows about the product, and it's not just celebrities who own it. Okay. So now it's people like you and I, because we consider ourselves intelligent investors. We're still in at the bottom portion of the move, right? Don't get me wrong, in the real world, guys, we can get in down here. I'm just using it as an analogy. So you get in there. Okay, by the time you start to move up to here, it's full-blown mainstream. Full-blown mainstream. Everybody knows about it. It's like the iPhone 7. It's not brand new. It's been out months already. Everybody knows about it. Now, as you start getting up here, this is when the really smart people down here at Goldman and the celebrities, hey, a celebrity has to do what? They have to stay in front of trends, not behind trends, correct? So if you're Jennifer Aniston, those jeans have been out a year already. You can't be seen in those things anymore. That's old news. You're on to the next big thing, right? You can't wear skinny jeans on 2 consecutive red carpets. Oh my gosh, sacrilege. You need to be on mini skirts now, or whatever it is that's next. Okay? So all the big boys are going, you know what? Now it's time to upgrade the stock. This is what they do. If you think I'm kidding, you got another thing coming. It's exactly what they do. All right, we're in down here. We need one last bump, one last pop. We want to get out. They upgrade the stock up here. Okay? Most average Joes lack serious confidence, which means they wait too long. Oh, I don't want to get in it down here. I don't want to do that. You know why? Now think about the logic. Because the last time I did this, this happened. This happened to me. They got in just after a stage 4, right, and it just tanked. So they're thinking about it like this, right? They're thinking stage 3 and it tanked. So they're not willing to get in down here because they lack confidence. So they get in up top because they need to see confirmation, right? The average Joe isn't that smart and they need to see confirmation. Well, at the same time they're getting confirmation, they're beginning to think about the stock in here, but they're not ready yet. Finally, up here, they make the plunge. The average Joe makes the plunge. That plunge is the last pop of a stock, the last bastion of a stock. That's when Goldman's getting out, the celebrities are getting out, you and I are getting out, and the average Joe, which is 80% of the people out there, are just getting in. And the worst part about it is these big corporations and hedge funds are telling you it's a great time to get in. I'm upgrading the stock from hold to buy or very strong buy, etc. And you get in for that one last pop. And as soon as you get in, stock goes sideways. Why is it going sideways? Because all these people down here are getting out now. Then it's the battle. The Joes are saying, ooh, this is a good investment. And the pros are saying, no, it's not. The Joes are saying it's a good investment. The pros are saying, no, it's not. The Joes are saying it's a good investment. Who do you think wins? The pros always win. The pros always win. So the Joes get in. It's a lot of them. And the back and forth. It's higher, it's lower, it's higher, it's lower. Okay? And then all the hedge funds dump. They don't all get out at the same time. That's why they can't all get out right here. You and I start to dump. Everybody starts to dump, and the stock starts to pull back. The Joes are not convinced yet. Whatever. I've seen this happen before. I'm the, fool me once, fool me twice. You know what I'm saying, right? I'm going to hold. Starts dropping, starts dropping, starts dropping. Once it starts getting in this range, they start thinking, it's not coming back. Maybe it's coming back. No, it's not coming back. Maybe it's coming back. They're still having a tug of war. By the time we get down here, the average Joes are like, screw it. It's not coming back. Oh, it's not coming back. Can't believe this happened to me again. And the cycle starts all over again. At the bottom, those average Joes don't ever want to hear the word stock ever again. Guys, think February, March 2009. I don't know how many of you were in the markets or had investments or anything of that nature, okay, at that time, all right? But I was firmly in the market at that time. And people at that time didn't want to hear the word stock. People were selling their 401ks, dumping, liquidating them for 30 and 40% down, literally getting 60 cents on the dollar. Not but 2 months after they're doing that, the market went on probably the biggest bullish run in history. Okay, biggest bullish run in history. The average person is always behind the trend because they don't understand how market cycles work. And this is exactly why I didn't just tell you stage 1, 2, 3 and give you the emotion. I gave you an analogy for it. So now you can understand what other people are thinking when it happens. And remember, not everybody can get out of a stock at the same time, right? Think about the restaurant analogy. You're in a restaurant. Maybe there's 100 seats in the restaurant. Some people are in the back of the restaurant. Some are in the middle of the restaurant. Some are sitting right next to the entrance of the restaurant. Somebody rings the fire alarm. Somebody smells smoke and yells, "Fire, get out." The door is what, 32 inches wide? How do 100 people get out of a 32-inch door at the exact same moment? Impossible. The people close to the exit get out first. Everybody gets out later and later and later And later, and some people, by the time they get out, because they're in the back, they get burnt, and they get burnt bad. That's how you have to think about this. Guys, we don't trade stocks, we trade people. Period. Okay? All right. The 3 chart keys, guys, these are things I need you guys to understand. So that's the market cycle. Okay? Stage 1, Stage 2, Stage 3, Stage 4. You need to understand how markets operate. Now, how do we take advantage? Through candlesticks, of course. How did the bar form? Where did the bar form? And how did it get there? Right? How did the bar form? Basically saying, hey, is it a bottoming tail? Is it a topping tail? Is it a narrow range bar? Is it a wide range bar? Where the bar is, it's exactly what it says. Is this bar forming? Hold on. Is this bar forming up here? Or is this bar forming down here? That's the where. Where did it form in this trend, this market cycle? Where did it form? Okay. How the bar formed, we're going to talk about in a second. And then again, how did it get there? Okay. Did it get there after 8 bars in a row up? Or did it get there after 1 bar up? Okay. So we're going to look at the key components. The first one, the basic candlestick. Who's in control? Okay. So right here, we have a green bar and a red bar. Bar high, bar low, pretty simple, right? That's the bar's low, that's the bar's high. These things right here, guys, are often referred to as the wick. See the little tail at the top, the little tail is often referred to as the wick. The green part is referred to as the body of the bar. Okay? The red part, the body of the bar. This basically means, guys, this is where the bar opened. This is where the bar closed. The body is the opening and closing of the bar. Write that down if you have to. The body of the bar is the opening and closing of the bar. It's not the range of the bar. Sometimes it is, but it's not always the range, right? It's the open and the close. So this bar opened down here, probably pulled back just a little bit, and then went higher, 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 all the way up to the top, and then pulled back just a little and closed right there. This is a wide range green bar, which means the buyers are in control. Okay? Wide range red bar means the bar opened at the top, moved up just a little bit, came all the way back down to the bottom, and settled right here. It's completely red and it's pretty big, which means sellers are in control. But remember, it's very important, and we're going to talk about it multiple times. Who is in control? It says buyers are in control. But guys, if this green bar happens after 8 other green bars, the chance that you're going to other green bars, the chance that you're going to see a red bar next is very high. So it might say, oh my gosh, it's a green bar, buyers are in control. But they might be in control for a very short period of time, depending on where the bar formed. So notice, it's not just how it forms, it's also where it forms and how it got there. Okay, is it forming right at a resistance point? Is it forming at a resistance point after 5 bars in a row up? All of these things put together give you a far better understanding of whether or not a trade is viable or likely to work. So let's take a look. Candlestick formations. So right here, guys, we have the green bars at the top, the red bars at the bottom. Notice as buying pressure is increasing, it equals bullish. Selling pressure is increasing, it equals bearish. This is a very important slide. Okay, for candlesticks, it's one of the foundations of finding good trades. This is what we call a topping tail. Okay. Remember, guys, the body of the bar is the opening and the closing of the bar. The body of the bar is the open. So, in this case, this bar opened at the bottom right here. Okay, that's where it opened. And then what happened? The bar went green, 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 green. So at one point in time, this bar looked like this bar, right? At one point in time, this bar was green, 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 and it looked exactly like this bar. But by the time the bar closed, let's say it's a 5-minute bar, hypothetically, it could be any time frame. It could be a yearly bar, it could be a 1-minute bar. Let's just say it's a 15-minute bar, 15-minute bar, okay? So maybe 13 minutes in, this bar was completely green. After 15 minutes, though, it wasn't. So tell me, talk to me. Who came in? What happened to make this thing less green? What, by definition, had to happen? Who came in? One word answer. Who came in? This was full green at one point, and now it's not. It's got a huge topping tail. What happened here? Ping pong. Sellers. Buyers, 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 buyers. Boom, it hits the top. Why? I don't know. It's only one bar. I can't see. We're going to find out in just a second as well. Sellers came in. Sellers, sellers, sellers. So what does that really say to me? Even though this bar is green, buyers aren't really in control. Why am I saying this in slow motion detail? Because it says who is in control. Oh, the bar is green. Buyers are in control. Not always. Bar is green. Buyers are in control is not always true. Bar is green, but buyers are not in control here. Sellers are in control. Look at the size of that topping tail. This to me means selling pressure is increasing. So you know how it says buying pressure is increasing? Notice the arrow points this way. Yes, buying pressure is increasing this way. But this is actually a very weak candle bar. This is a very weak candlestick, even though it's green. That is so important. You have to understand it. Okay? Right here, now what do we get? Topping tail and a bottoming tail. The body of the bar is in between or, quote, neutral. Yes, it's green, but it's neutral. Okay? This thing started here. How did it form? I don't know. Probably went lower first, then went higher, then came back. Or it could have gone higher, then gone lower, then came back up. I don't know how it formed. But I do know that buyers and sellers are fighting it out right here. Okay? Topping tail suggests sellers came in. Bottoming tail suggests buyers came in. Okay? Yeah, there's a level of uncertainty here. But, and this is key, guys, and we're going to get to it in a couple minutes. It's not just how it formed, it's where it formed. So tell me this, and tell me this again. If I have 8 red bars in a row, go red bar, 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 and then this bar forms. More bullish or more bearish? 8 red bars in a row, and then this bar forms. Talk to me, guys. More bullish or more bearish? Which is it? More what? More bullish or more bearish at that point? Exactly right. Exactly right. More bullish. Now let's flip the table. Let's flip it and do the opposite. Green bar, 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 and then this bar. More bullish or bearish? More bullish or bearish at that point? That's it. More bearish. Guys, it's the same bar. It's the same bar. How can it be more bearish in one scenario and more bullish in another scenario? Because where it forms on the chart. This is why you can't just trade individual bars. You have to trade the bars within the context of the chart. It's key. It's massively important because this bar could be the most bullish bar you've ever seen, and it could be a massively bearish bar at the same time. Yet, it's green all the time. Okay? This is the same, guys, but the body of the bar is a little bigger, which means it closed a little higher, right? It opened right here, dropped, popped, but it closed a little higher. Very similar bars, though. Okay, so I'm not going to spend as much time on it. Now, this bar, however, is very important. All right? Remember, the body is where it opens and closes, which means if it's green, it opened lower and closed higher. So this opened here and closed here. So what likely happened here? Well, this right here opened there. That's guaranteed, not likely. That's a guarantee. It opened right where the tip of my cursor is. And then red, 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 red. This bar at one point looked like this, right? This bar looked very, very similar to this. But it ended up looking like this. So sellers came in, sellers came in, sellers came in, sellers came in, and at the bottom here, the buyer said, no, 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 no. Bounced it back up. That, ladies and gentlemen, is an extremely bullish bar, right? Extremely bullish because it went to battle, it went to war, and it won, right? It got tested. This bar is battle tested. This bar is also battle tested, but it lost the battle, so it's weak. This bar is battle tested, but it won the battle, so it's stronger. It's stronger, okay? This bar was red at one point, and now it's green. So the question then, which is stronger, this bar or this bar? I'll save you the suspense. It really depends. Depends on the last thing. How the bar formed and how it got to where it is. Okay, so how did this form? Did this go straight up? Okay, that's bullish. Or did it go up, down, up? All right. The same, and I'm going to show you this on the next slide. Okay, the same is true on the short side, guys. All right, I'm not going to go over the short side as much because it's the same concept. This bar is actually quite bullish right here. This bar is extra bearish, but keep in mind something. Guys, if this stock is up 10 bars in a row, green, 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 and then this bar forms, it's still not that bullish because it's extended, it's tired. Okay, it's extended and it's tired. Okay, now take note. I'm gonna pull a chart across here real quick. Okay, you see this? All right. Notice 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bars down. 11 bars down, bottoming tails. That's super bullish. And notice it became really bullish. 11 bars down, huge volume bottoming tail. Buyers are stepping up. Buyers are stepping up. Very, very bullish. Okay? Very, very bullish. It's always within the context of the chart. Let's take a look. How did it form? It's important to look inside the bars. We do this by drilling down to a lower time frame. So let's say this is a 15-minute bar. And let's say that's a 5-minute, 5-minute, 5-minute. 15-minute bar right here. 15-minute bar, 5-minute, 5-minute, 5-minute. Okay? Well, obviously because it's green, it started at the bottom and went up, and then it went down, and then it went up. That's one way this could form. There's a lot of ways this could form, guys. Take a look at the bar. It could form this way. Go up, leave a topping tail, and go back up. It could just go up, up, up. This is all the same bar. I want you to notice that. This first bar, this 15-minute bar, it's the same here, it's the same here, and it's the same here. But how they formed is completely and totally different. For me, my preference is this one. Because I love when stocks are tested and they pass the test. I'm not suggesting it. I want to make this clear also. I'm not suggesting that this is not bullish. This is extremely bullish. I have no problem with this. But over here, the sellers tried to come in, and they got spanked. Buyers come in, the sellers go, no, 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 no. And then the buyers say, oh, wait a second, I don't think so. So it's tested. It's battle tested. So now you know it's strong. It went to war and it passed. Okay? You don't really know how good somebody is until they've been tested. This is tested. This is not. Now, again, don't confuse this. I'm not saying this is weak. It's not. It's bullish. Purely bullish. But I like when they've been tested. So, guys, what I want you guys to get in the habit of doing is always drilling down. Okay? 15-minute chart, go down to the 5, see what it looks like. Go down to the 2-minute, see what it looks like. Okay? See what it looks like. Then you'll have a far better idea of how the bar formed. Okay? When you combine the how the bar formed with the where the bar formed, now we're getting somewhere. Now we're starting to become much more accurate, okay, with choosing stocks. So, where did it form? Topping tail bar, red bar, red bar, red bar, red bar. 1, 2, 3, 4, 5. Bottoming tail bar happens after what? 5 red bars, 4 red bars, 3 of which are wide range bars. That's a very big bar. There's a lot of selling pressure, a lot of selling pressure, a lot of selling pressure. But then the bottoming tail comes. Remember, this bar at one point was completely red. Completely red. 100% red. And guess what? It ended up small red after 5 bars down, 4 bars down. That means bounce. That means bounce. So candlesticks are only meaningful in the context of the chart. Okay? You could show me this bar or this bar in a vacuum and it doesn't mean much. When you put it on a chart, it means bounce in this case. Topping tail after a couple bars means probably a little pullback. You come back down here, buyers came in right here. Buyers will probably come in again. Probably. Because the stock's so extended. Stock moves up, pulls back, moves up, pulls back, moves up. Now, narrow body bar, it's basically meaningless in the middle of this move. It's just a small resting bar and the stock is likely going to go higher. Now, if this thing put in a huge topping tail, I would say probably lower prices. But it's just a small little resting doji. So in this trend, it's not extended right here. So when you look at it right there, no big deal. This bar, however, you're 3 or 4 bars up, there's resistance to the left, you're probably going to get a pullback, right? This basically means, hey, buyers are in control, buyers are in control, buyers are in control. Oh, tug of war happening. Well, where it's happening is at resistance, right? It's at resistance, and it's red, which means sellers stepped up, probably going to get a pullback. You get a pullback into double bottom support, buyers come in and completely engulf the bar. This is a very, very powerful sign. Anytime you can take out a wide bar with the next bar, so this is a wide red bar, take it out with a wide green bar is extremely potent. Okay, now you're up 1, 2, 3, 4, 5 bars into resistance. The prior pivot high is where sellers came in before, so they will likely come in again. That's exactly what happened. Profit taking, right? Moves up, moves up, moves up, moves up into resistance, even though it finished at the high. It finished at the high. It's up 5 bars into resistance. Expect some profit taking, even though there's no topping tail. Stock gap down the next day. Gap down. Okay? Shortable. Topping tail bar, honestly, guys, I put this in here on purpose. Honestly, I expected this to go a little bit lower. A little bit. Now, granted, there's support here, but I expected that to go a little bit lower. Pops back up. So where it forms on the chart. So, is this bottoming tail bar significant? Yes and no, right? It's significant because it's showing the strength of the buyers. But it's also sitting at double top resistance after a strong move up. What I'd like to see is 2 or 3 consolidation bars right here, and then a continuation move. So after this bottoming tail, I'd like to see 2 or 3 resting bars, and then a continuation move. Okay? How did it get there? Okay? So, we talked about how a bar forms, where a bar forms, and now how it's getting there. So, you look here and you're 1, 2, 3, 4, 5 bars down. Look at the volume spike. Okay? So, we're looking at a bar that has a small bottoming tail. That's the how it formed part. Where it's at on the chart is down at a pivot bottom. And how it got there is after 4 or 5 red bars. All of these things suggest a bounce. This stock is overly extended. So I would expect, at least at a minimum, a short-term bounce. At a minimum, short-term bounce. consolidate out, blast off. Now, that's an ending bar because it's fourth bar, it's the biggest bar on the chart, and it's on volume. Expect the next bar or two to bounce. Now, this little bar, narrow body bar in here, this narrow range, narrow body bar, is this really significant in this consolidation? The answer is no. Right? So you have to look at the bigger picture to get the significance of each bar. This bar, not terribly significant. Why? It's just stuck in the middle of a consolidation. This green bar is significant. Why? Because it's engulfing this red bar. It's taking out the sellers. The sellers tried to come in and go lower, and the buyers stepped right back and said no. No. So within this consolidation, this bar is significant, but this bar is not. And the rest of these bars are just resting bars. And then this is a wide range igniting bar. So this bar is very significant, and it happened on volume. Okay? Expect this to go higher back to the prior pivot, right? So it got to the bottom after multiple bars down. It put in huge volume with a little bottoming tail. All of those things, extended, big volume, and a little bottoming tail. All three suggest higher prices. All three suggest higher prices. Okay? In some of the previous charts, they were given green volume bar that had different lighter green that means something. No, the red volume simply means there was more selling volume on this bar than buying volume, but the color of the green is probably just a lighter green. But no, the color of the volume bars is less significant. Don't be too concerned about that. How much volume is what's most important. But when it's more red, it means there was more selling pressure, more selling volume, and this means there's more buying volume. Okay, guys, same deal here. Same bar, same meaning? I don't think so, right? This is an igniting bar. This bar is starting the move. It's beginning the move. This bar is ending the move, right? So you talk about where it's forming and how it got there. Well, this bar is forming as one of the first bars. This bar is forming as the fifth bar up. So when you look at this bar, that's an igniting bar because it's the first bar of the move. First bar of the move, igniting bar. Fifth bar of the move, same bar, but now you have to look what happened previously. 4 other bars. This move is likely over. Now, does that mean it's going to come back 100% like this? No. A lot of times it just means a shallow retracement and it'll bounce. Now notice here, topping tail, same meaning? No. Right? This topping tail, simply at support. Buyers tried to make a move. Sellers said no. Point being is, this topping tail up here suggests lower prices. This topping tail really is meaningless, meaning you're already near support. The stock is likely going to bounce. So whether this is a wide range red bar or a topping tail bar, I'm expecting buyers to step up. Why? Because it's the 5th bar down at support. This topping tail is meaningful, okay, because I'm expecting this thing to pull back. It's at resistance, okay? Would you ever buy in an igniting bar? Absolutely, that's when you want to buy. You want an igniting bar. In this case, you would buy right here above the breakout, right? You would buy it right where my cursor is, right there, where the stop loss down here. So yes, you would buy this. Now, would I buy the high of this igniting bar? Probably not. I want to look to the left, Cesar. I want to look to the left, and I want to buy where it breaks resistance. And you'll see that with our 3-bar plays coming up. You want to buy where it breaks resistance. You don't really want to buy the top of it because it's a wide bar. If you buy the top of it, that means your stop loss is all the way down here, right? So do you want to buy up here, for example, and have a stop loss down here? Not really. I want to buy right here when it's breaking resistance and put the stop loss down here, okay? Get a better reward to risk. So again, guys, same bar, but this one has very little meaning because it's coming after 4 red bars. Topping tail just means, hey, I'm going to bounce anyway. Whether it's a red bar or topping, I'm going to bounce likely in this area. This means pullback. You're up multiple bars. You're at pivot resistance. So keep in mind how a bar forms, where a bar forms, how did it get there. Okay? Oh, 1 second here. 80, 80. Oh, 1 second here. 80, 80. Okay, sorry guys. All right. Great example here, okay? We have a stock that's in a downtrend. It bounces, it retests, okay? Buyer stepped up, all right? It was extended, and that's why it bounced. How did this bar form? Where is it forming? Well, it has a bottoming tail. That means buyers. It's really extended. That means where it formed, it's likely to bounce, okay? Bounces, pulls back, again, almost to that area. Bounces, oh, sellers come in. Why? Well, sellers came in here. Sellers are probably going to come in again. Pulls back, bounces. Now, this is where we're going to focus. What can we expect here? 1 red bar, 2 red bars, 3 red bars, 4, 5, 6. 6 red bars. Couple wide range red bars. So 6 bars down, wide range ending bar volume spike. Notice the volume right here is one of the biggest volumes on this whole chart. It's probably top 3 or 4, right? It's coming after 4 red bars. So 4 red bars plus a wide range ending bar plus a volume spike at support, right? Buyer stepped up, far from the moving average. Guys, oh my goodness. It's like somebody telling you and then slapping you in the face and then slapping you in the butt and then saying, dude, wake up. It's not just one thing, 6 bars down. It's not just 2 things, wide range ending bar. It's not just 3 things, volume spike. It's not just at support. It's also far from the moving average. Guys, this is what I mean by putting it all together. Multiple concepts converging in an area equals higher odds. I'll repeat that, write it down. Multiple concepts converging in an area means higher odds. So we have 5 concepts here converging at one point. 6 bars down, wide range ending bar, volume spike, at support, far from the movement. It's going to bounce. 100%. First target 50%, second target 100%. So you're in at $29.50, your stop loss is $29. $29.50, 20, that's 50-cent stop loss. First target, $30.50, 2 to 1. Second target, $31.50, 4 to 1. That's 100% retracted. First target, 50%. Second target, 100%. This stock is likely transitioning from a stage 4, micro stage 4 downtrend, stage 1, back into a stage 2, most likely. Okay? Guys, multiple candlesticks form pivots. These pivots form areas of support and resistance. It's from these areas that we typically enter trades. Remember what I just said. We do this by looking for, I think this would be a good time to make this in blue and bold. We do this by looking for multiple concepts to converge in one area. Okay? When you get multiple concepts to converge in an area, you're increasing the odds that the trade will work. And that's what we want, because increasing the odds means more money. So you might look for a specific pattern, as say a buy setup with a bottoming tail or a green bar, increased volume, right? The more concepts you can get, the better off it is. Okay? We're odds traders, just increases our odds. Okay? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bars down, big volume spike. This creates a support point. Pulls back, bounces, pulls back. Resistance is at 95-ish, give or take. Support is at, I don't know what that is, 78-ish, give or take. Okay? The stock has tested this area on multiple occasions. Tells us buyers came in here, they'll probably come in again. So wait for it. Same chart. Okay? I said I put these in here on purpose. Now let's go through the checklist. Same chart. Multiple bars down. The resistance area is still 95-ish, 94, whatever. The support area is still in that 78 range. Buyers came in here. Buyers came in here. Well, now we have what? 1, 2, 3, 4, 5, 6 bars? Well, it says 7. 6 to 7 bars down. Several are large bars. Wide range bar here, kind of a wide range bar there. Multiple pivot support. Support, support. It's coming into support. Buyers came in, they're probably going to come in again. Increase volume. Look at the volume spike right here. Okay. Green bar at the bottom, which means buyers are stepping up. Bottoming tail, buyers are stepping up. What do you think is going to happen here? You're going to get a bounce. So you're in at $80, give or take, $2 stop loss, 50% first target. So what's that going to be? I don't know, 88 bucks. Second target, 94. So first target's about 4 to 1. Call it a $2 stop loss. Second target is about 14 to 1, or sorry, 7 to 1, right? $14, 7 to 1. Guys, this is a daily chart. This is a swing trade. Now, a lot of you are going, well, I didn't notice that. Well, this is what we mean by pivots and multiple concepts, higher odds. Yes, it's not in an uptrend. It's not yet. But the likelihood this bounces off the bottom is about 90%. And you can see it already by this bar. Guys, after the first day, you're up 2 to 1 on the trade. It's a $2 stop, you're up $4. You've already made 2 to 1 on your money. If you risked $1,000 on this, you'd already be up $2,000 in one day. Multiple concepts together, multiple concepts converging. The more you can get, the better you'll be, the more reliable your trades will be. Okay? Volume, one of my favorite things in the entire world, guys. To me, volume is almost as important as price. Okay? It says right here, price and volume are the two most important things on a chart. At Live Traders, we feel that they are of equal importance because you must have both to be able to take a trade. The greatest pattern in the world is worthless unless there are shares to trade, which is volume. The highest volume in the world doesn't mean anything if it's not happening in the right place, price. They're of equal importance. Okay? This, write it down, memorize it. Price tells us what is happening, higher, lower, neutral. And volume tells us how it's happening, i.e., with or without commitment. Okay? Does this stock have commitment? Guys, when I say commitment, what I'm thinking is big institutional money. Big time institutional money. Guys, the average guy, the average trader is not buying 5 million shares of a stock. Okay? Institutions are doing that. You want to piggyback that big money. The best trades always have multiple concepts converging, price, volume, moving averages, market timing, etc. We do not trade in a vacuum. Okay, let's take a deeper look. We have 3 types of volume, guys. Igniting volume, ending volume, and resting volume. Okay, igniting volume ignites a move in a new direction, or it continues an already strong move, but it cannot be an extended move. When I think igniting volume, I'm thinking double average volume. So if a stock is normally doing, I don't know, 500,000 shares, I want to see 1 million shares. All right. When I see igniting volume, I want to see at least double. I want it to be noticeably higher volume. Okay. Ending volume is simply that. It ends the current, usually extended move. Ending volume is something you'll see after 4 or 5 bars up or down. Okay. Again, at least double volume. I want it to be obvious to you. I want you to look at it and go, oh my gosh, where did all that volume come from? That's crazy. And you'll see on the next couple slides what I mean. And then resting volume is simply, guys, narrow range, quiet volume, light volume. Is typically for a pause. Typically, you'll see resting volume in the middle of stage 1 or in the middle of a breakout, right? Resting volume is something you'll see in the middle of a breakout. Okay, it's roughly half the average volume. Okay, we use these types of volume, okay, to help us decide or discern when a stock might be ending a move, when it might be igniting a new move, or when it might be just resting so that it's able to continue its current move. It's that simple. Okay. All right. If increased volume happens here, it's igniting volume. Why? It's the first bar of the move. Right? It's the first bar of the move. It's igniting. But if increased volume happens here and it's a wide bar, remember, multiple concepts conversion, it's ending. Increased volume after a robust rally or fall usually means a likely reversal. Okay, so ignites the initial move. This is beginning the move. It's starting the move, igniting volume. Now, 1, 2, 3, 4, 5, 6 bars down, wide bar. If you get volume here, it's ending the move. Same on the flip side. If you get a big volume spike here and a wide bar, it's igniting volume. If you get the same volume and the same bar up here, ending volume. There's that prior pivot high, and you're up 1, 2, 3, 4, 5, 6 bars. So again, where it's happening, let's take a look. Okay. Now notice you have a stock. Gaps down a little bit, it's trying to hold this range and finally breaks. Goes lower, bounces, goes lower. Notice the size of this volume, the size of this bar with that volume. The stock has dropped now from 117 down to 104 on a wide range bar, massive. It's the biggest bar probably on the chart. That's ending volume. Bounces, pulls back, bounces, pulls back. But now notice, up 1, 2, 3, 4, 5, 6, 7, 8 bars in a row. What do we have to the left? Resistance equals sellers. Okay? I don't know where I got 9 bars at. Confused, I'm off by my bars. But nonetheless, it's up 8 or 9 bars in a row. Multiple wide range bars, right? There's a wide range bar here. There's a wide range bar here. It's far from this moving average. Okay? There's resistance right here and right here. And then you also get a topping tail. That's the next day as well. This move's over. That's your ending volume. That is ending volume. Even though it went up one more day, the move was over right here. I would not have stayed in this thing. Okay, yes. Did some people stay in it? Obviously, it gapped up. But then what did it do? As soon as it gapped up, it just sold straight off. $10 pullback, $8 pullback. Okay? So what I'm trying to show you here, guys, is multiple concepts converging in an area. You have a stock that has resistance at the 119 range. You have a stock that's approaching the 119 range after many, many bars up on huge volume, far from a moving average, at resistance. You're getting a pullback. Volume tells us if I took this trade on this pullback, let's say I bought this double bottom at 108 with a stop at 106, my target area unequivocally is this red line. My target area is that red line. So I'm in at 108 perhaps. Stop 106, $2 stop loss. I'm up here at 118-ish. You just got a $10 move. That's 5 to 1. And you see a wide range bar on, I mean, guys, stupid volume, right? I mean, if you look at average volume, it's probably 500,000 or 600,000. It's doing 2 million. It's doing 4 to 1 volume. Get out. Don't wait for this gap up. It's going, it may not gap up, right? I mean, you're already at resistance at this point. You're already at resistance. Get out. If you're still in, if you happen to be crazy and held it overnight, and then you see a topping tail, get out. Worst case, stop loss goes under this green bar. And then the next day you get taken out right there. Call it 119. Worst case. Do not be a fool. Do not be overly greedy here and let this come all the way back against you. Guys, multiple concepts converging in an area. Volume spike, 9 bars up, multiple wide range bars, far from the moving average, double top resistance. It's done, it's over, it's finished. Take your 5 to 1, smile, and move on. That's good trading. Okay? Let's take a look at a couple more. Okay? Now we have what? 5-minute chart, consolidation. That's resting volume. Remember, the stock moved from 41.40 up to 42. This is a 5-minute chart now. It's a little tired, right? Just moved up a lot. That is consolidating, and notice the volume is thinner. It's quieter, okay? When it breaks out above the consolidation, we get IV, or igniting volume, right? Beautiful igniting volume, because it rested back to the rising moving average, blast off. Now, the same bar happens up top. The same volume happens up top. This bar is bigger and this volume is bigger, but notice they're totally different concepts. Same bar, same volume. Same bar, same volume. Location, location, location. Where it's happening is just important. We talked about it many times. I'm continuing to reiterate it. This bar is igniting and it breaks out. It's a new move. Now you're up 20 bars in a row. You're extended and far from the moving average. Guys, take your money and run. Take your money and run. Put your stop loss, or I just sell into strength, or put your stop loss under that red bar. Don't be overly greedy. Let the volume guide you. Same deal here. Notice the consolidation. Resting bar. Notice the green bar that ignites the new move. What do you have? Increased volume. Both bars, increased volume. It's a new move. It gapped up over this area, new move. Now, resting period. After that strong move, the stock is tired. It just got done running a big race. It needs to take a break. Refuel. Quiet. Easy. Woosah. Resting volume. Boom! Blast off over 32. Look at the volume, guys. You're talking, what, 50,000 here and over 200,000 here. 4 to 1, 5 to 1 volume. That's igniting volume. Says, what's this? Telling you, it's igniting volume. Now, you see this volume over here? Up, 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 somewhere around here? I'm starting to get a little concerned. Volume starting to come in after an extended move. You might want to think about taking some of your shares off. Okay? Look at it again. The novice volume ended the move. The pro volume ignited the move back up. Okay? So this is a summary. Stock, guys, was doing what? Stuck in a sideways range. Notice? Resting volume. Okay? No, don't worry about the lighter green bars. Don't worry about it at all. Okay? See the resting volume here, guys? Just chilling out in a range, in a range, in a range, in a range. Nobody cares. Stock's just hanging out, recuperating. Guys, real quick, that at the moment, at that time, was ending volume. Short-term ending volume, right? Wide range bar, bottoming tail, huge volume. It stayed in that range for 2 hours. Then what happens? Finally, under $44, support is broken. Then the stock loses it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bars down. Notice the volume coming in now? So, you tell me, guys, that red bar, that volume, what kind of volume is it? Talk to me. You got a 33% chance of getting it right. Wide range red bar, volume spike. What type of volume is this? Talk to me. You have 3 choices. You have ending volume, igniting volume, or resting volume. And we have dispute. Which is it? That's igniting volume. Guys, this red bar, what did this red bar do to this move? Did this red bar end this move, or did this red bar start this move? That red bar right there. Did it start this move down? This bar right here, what I'm circling. Or did it end this? It started the move. This is pivot support. Support and support. That bar broke support for the first time. Support, support. This bar broke support for the first time. It's igniting that move down. Okay? Nope, I'm pointing to the volume right here. If I want to point to that bar, I'll move the cursor right there. No, but seriously, right? Wide range bar on huge volume. And notice, the volume before this bar right here, light volume. Nobody cared. This bar starts the festivities. You actually have a 3-bar play right there. And then, big volume all the way. Now, you're coming into ending volume. Doji bar, little bottoming tail, ending volume here, and igniting volume here. So you can have back-to-back. You can have ending volume here and igniting volume there. Boom, bounces it back up. Guys, volume is extremely important. Massively important. It's just as important as price. Last and definitely least, moving averages. I won't spend as much time on moving averages because, as you know, I personally don't use them. You know who uses them and does a great job with moving averages? Unmol. Okay, for those of you who know Unmol in the Forex room as well as the stocks room, the guy is a master of using moving averages. Okay, personally, price and volume I think are the most important things that you need. Okay, 21 period exponential, 21 EMA, and a 200 period simple. You can use a simple for both or an exponential for both. It doesn't matter. Okay? You must understand, though. You must understand. Yes, he's a master at VWAP as well. Volume. You must understand, though. You must understand. Yes, he's a master at VWAP as well. Volume weighted average price, right? You must understand. These are subjective indicators. Moving averages are not actually price. They represent the flow of the chart, but they're not actually price. They're just a guideline for areas in which a stock might potentially pivot or might stall in an area, okay? You must have a pattern to take a trade. A moving average is just a guideline for a trend. Let me repeat this. A moving average is a guideline for a trend. The candlesticks are the actual patterns, okay? Right. 21 period moving average, okay? Consolidate, consolidate, big gap up. Notice the gap up takes it really far from that moving average. So what do? Pull back into it, chop around. Notice when we get close to the moving average is when the stock bounces. You're going to find this to be very, very, very common. When you touch the moving average or get very close to it is when a stock will typically bounce. Okay? Oftentimes, this is not the case right here, but oftentimes there will be some type of support to the left, and you'll see that on a couple more charts. Okay? So bounces, pulls back, bottoming tail, buyers. So guys, that ending volume right there, right? 1, 2, third bar down, bottoming tail, ending volume. Stock bounces back up. Okay. Back to the moving average. It's retesting the prior pivot. Buyers stepped up here. Buyers will step up again over here. Stock moves up. Notice every time it gets too far from the moving average, it pulls back. You're going to notice that's a common theme. I'll repeat it. When a stock gets too far away from a moving average, it almost always pulls back towards the moving average. So the moving average acts like a magnet, right? The moving average acts like a magnet, okay? Notice the moving average is relatively flat here because the stock is relatively flat, right? It's not going anywhere. It's in like a dollar range, 40-cent range here. 88.80 up to 89.40-ish. Just stuck. So the moving average is going right through the price action. When a stock goes sideways, it's important. Note it down. When a stock goes sideways, moving averages become much, much less important because they're not helping you discern anything. When a stock is in an uptrend or a downtrend, moving averages become much more important. So now, notice, right here, we're getting far from the moving average. That is an indication that the stock needs more time to rest. I'll repeat, far from the moving average is an indication the stock is either extended or it needs a little bit more time to rest. So what do? We consolidate back towards the moving average. Remember I said on the last slide, when you get to a point where you touch the moving average or you're close to the moving average, the stock will then bounce. It's exactly what happens here. You buy it at 90, the stop loss is like 89.90, 89.85, 10 or 15 cent stop, it moves $1. Guys, what type of volume? Igniting volume. Look at the base. Consolidation. Quiet resting volume. RV resting volume. IV igniting volume right there. Perfect. This chart is perfect. Okay? When the stock consolidates back to the rising moving average, this signals an adequate amount of rest and typically means the stock will continue its move higher. One last comment, one last note. This is a 21 period moving average. When you get down to a 1-minute chart or 2-minute chart, you can use a 9 period if you want. Okay? Particularly on a 1-minute. This happens to be a 5-minute chart, but when you get down to a 1-minute, you can use a 9 period moving average if you want. Okay? All right? Putting all three tools to use. Candlesticks, which is price. Volume, moving average. Now, Notice the resistance is right here at, I don't know, 37.30. Stock breaks above it, bounces, bounces, bounces. Notice, what are we right here? We are far from the moving average, which means we need a pullback. We said it on the last slide. We'll go back to it real quick. Okay? When the stock pulls back or consolidates back to the moving average, this signals an adequate amount of rest and typically means the stock will continue higher. So now, instead of a consolidation, we have a pullback. You don't use the 20 because you have an idea, whereas based on your experience, Carl, you can use the 20. I have no problem with the 20. You can use the 20-period moving average. At this point, it's semantics. It's like somebody saying, I trade off a 3-minute chart, but I trade off a 2-minute chart. It's the same thing, right? So yeah, no problem there. 20, 21, it's all good. Simple moving average, exponential moving average. You know, everybody tries to be a little bit different, I guess, you know. So, stock moves up. Guys, 4 bars up. It's far from the moving average. Pulls back right to the moving average. It also pulls back to pivot support. Okay, pivot support, level 1 pivot support. What do we get here? Boom, igniting volume. Notice, far from the moving average, it pulls back. This is all 3 concepts, okay? The one thing I didn't put in here, and it was just obviously an oversight, is the 200-period moving average. Those moving averages are going to be much more relevant on daily charts, guys. Okay, they're going to be much more relevant on daily charts. Okay, those are things that market makers use, hedge funds use, but you're not going to have a 200-period moving average on a 5-minute chart. Okay, let me give you a quick example here. All right. This is a 200-period moving average. Okay, gapping over 1, 2, 3, 4, 5 bars. This is your target point. Notice that moving average is right at that prior pivot. In this case, it moved a little bit above it, but this red line is your 200-period moving average on a daily chart. Okay, so pivot here, pivot here. That's your target area, that 31 mark. Okay, so when this thing gaps up and you get in at $29.31 is your target. This happened to go a little bit higher. All right, but the 200-period moving average is something you will generally only see. Oops,